Welcome back to the Bitcoin layer. Today we come to you as Bitcoin is now back above $70,000 and it's raring to break out to $80,000 to brand new all-time highs and well beyond. Given that we are at the start of the bull market, at least that's what we believe here at TBL, we view Bitcoin as having much further upside to go. And after 3 months of a very tight consolidation period, Bitcoin is finally at the top of this range it's been trying to break out of for 3 months, and now it has the momentum behind it, it has the base behind it in order to actually get it done and challenge all-time highs and of course reach new ones. So before we get into all of that, just a word from our friends over at River. Invest in Bitcoin with confidence over at river.com. You guys, they are our Bitcoin exchange of choice. You can sleep soundly with peace of mind knowing that all the Bitcoin you buy goes straight into their proprietary multi-sig cold storage solution. It's not lent out to third parties, right? Like these silly crypto bucket shops, FTX, Celsius, all that other garbage. River is changing the game, honest and truly. They have 100% full reserve custody. They're licensed and regulated all across the United States, and they have US-based phone support as well. And they just introduced a new feature called River Link, where if you want to orange pill your friends or your family, you owe them money for something, you could text Bitcoin to anyone over the phone, and they can claim it to any wallet. So River, honest to goodness, is changing the game, you guys. There are Bitcoin exchange of choice. I use them when I buy my Bitcoin, and there are also zero fees when you set up recurring orders too. So what are you guys waiting for? Use river.com/TBL to get up to $100 when you sign up and buy Bitcoin. All right, so without further ado, let's get directly into the charts that I have for you. The first one here being this range that I'm talking about, right? So Bitcoin wants to break out really badly. You see over here, we've retested all-time highs, right? Kind of in this descending channel that I've marked here in light blue. Price action is very constructive. In the words of Caleb Franzen on X, who's a great analyst for unbiased Bitcoin PA analysis and commentary. You guys should go give him a follow. He has said that, basically what you've said here, that Bitcoin's price action is very constructive. You'll note that Bitcoin's price made lower lows for kind of, 4 to 6 weeks here in the early April to early May area, right? All the way from kind of late March to early May. It made lower lows that I've marked with this green line, and then it's flipped into making higher highs in this red line. And so it seems, right, given that we're trying to touch this the top of this range, right, we're trying to get back into this range, break up through the top of this range. It seems like this mighty consolidation is finally nearing its end. And actually, as I was striking this and writing this post that I did for Substack and writing this video, we were actually not even at the bottom of this range yet. And now, as you can see, we're challenging the bottom of this range. We are literally right there. And so a breakout is approaching. That's what we believe. And as we've once again bounced off that bottom red line, and we're touching the bottom of the descending channel in light blue. Okay, so that's kind of the price action. Obviously, lines on charts, who cares, right? Pseudoscience, garbage, whatever. Well, let's take a look at the futures market to see if what I'm talking about actually has legs behind it. And I do believe it does. So this is the futures market funding rate. Okay, well, what is the funding rate? Well, the funding rate is basically the amount of money that shorts pay longs to enter into positions, or vice versa, that longs pay shorts. Now, when the funding rate is positive, that means that longs are paying shorts in order to enter into positions. Obviously, when the market is long dominated, that is the position. That is the way that the market is heading. It's more expensive for people to go long. That makes sense. And so right now, there's very little flighty capital that's underlying Bitcoin's price action. Well, what do I mean by that? Well, the funding rate in Bitcoin's perpetual futures market is low, okay? So if we zoom back out to like 3 months here, you'll note, and I apologize if this is a little hard to see, but you'll note that compared to when we were at last at these levels in April, right? Look at how high the funding rate was. Longs were paying shorts 10% in order to, or 10 basis points rather, 7 basis points in order to enter into positions. And now they're only paying them roughly 1 basis point. Now, granted, it is still very elevated from where we were at the start of May. Over here is very subdued. But all the same, if you compare, we're at the exact same price level, and a much lower funding rate, okay? So that tells me that there are far far less of this price action is driven by people piling into these leveraged futures positions. So that means at current price levels, where we are now, spot buyers are making up the lion's share of buying and selling activity. So there's way less risk of huge upside and downside swings, right? Way less risk of this kind of stuff happening, okay? Do you see how much futures, how many longs are in the market right here, and how quickly they can get wiped on a downside move? So way less of this stuff, okay? Way less of this stuff, way less of this stuff. Now that the futures market looks like this. And so currently the dominant cohort in Bitcoin are people who are just buying it and holding it for however long. They could hold it for a day, they could hold it for 10 years, but the reality is that they're not getting in and out of leveraged futures positions, 10x, 100x leverage, which would lead to these huge swing moves. So to give you like an analogy for it, this is like a firm launch pad for the rocket ship per se. We're not taking off from like a landing pad on the ocean with waves, and you may take off, you might not. Chances are when you come back in, you might crash land. With very little froth in the futures market, same price, much less froth, we're shaping up to take off from a launch pad on the concrete from Cape Canaveral, okay? So I hope that made sense. Zooming out a little bit further, and you'll note I actually want more candles so that you could see a little bit better. Okay, that's a little bit better. Actually, let's do 1 day intervals. Let's see what we can get away with here. Okay, this looks good. So this dynamic has played out a few times actually. So zooming out further, you can note how the behavior over the last 9 months rather, during the current bull market, we've taken stepwise moves higher. So a stepwise move, moving around here, stepwise move, and now we're up here. So we've taken these 1, 2, or I guess you could call it 1, 2, 3, 4 legs up, right? However you want to break it up. But the reality is that this is like a stepwise function of a bull market. It's not like like 2020, 2021 into 22. It is more of a stepwise function if you guys like math, which I mean, you're watching me doing this. So if you're watching this long in this video, chances are you're a math person. So welcome to the Bitcoin layer. But the funding rate is low when Bitcoin is kind of building its base. And you can see this here, and then it cools off, and then it moves up, right? It hits this zenith when Bitcoin hits a local top. And then once again, it cools off as Bitcoin rebuilds its base for the next move, and then rinse and repeat. And then, when we're making a huge leg higher, funding rate spikes, people pile into the futures market. There's a lot of leverage that gets us up to these levels, and then it gets slowly purged, and then Bitcoin kind of chops around while it builds its base in the spot market, okay? So essentially, low green bars, rising green bars as the next leg higher Bitcoin spot price takes place, then huge amounts of leverage enter the market, right? And then the green bars come back down as the leverage declines, okay? And then rinse and repeat, we build another base, right? So that's what we're doing right now. Low funding rate, very spot driven, accumulation period. Leverage positions begin entering the market as Bitcoin price starts making this next move. Leverage gets purged, the base gets built, around the price that we topped out at. And that's happened. This has happened once, twice, and now we're at the beginning of the third time where I believe that leverage is going to re-enter the market, and we're going to, move much, much, much higher from where we are now. So we're nearing the end of this kind of third base building period that we have seen during the bull market, which of course began in earnest back in August. Look at that. If I wasn't doing this, I'd be a poet or something. At 25,000, like 25,000. Okay, wonderful. So that is futures. All right. So the last Bitcoin chart that I will show you is another one on my terminal here. And this is Bloomberg Bitcoin's price action plus the relative strength index. So the relative strength index is a momentum indicator. Okay. The lines that I have here for you are overbought and oversold, which is down here. And then kind of the midway point between the two, which is right around 50. Overbought would be around 70. Oversold would be around 30. So needless to say, it's a momentum indicator. Momentum is, to the downside here. Momentum is to the upside when you're up here creeping towards the, around here toward the oversold area. And so at the end of the aforementioned period where Bitcoin is building its base for the next move higher, RSI kind of creeps into overbought territory, but it doesn't explode above it. Okay, it's a slow creep above before the move commences. Notice right here. A slow creep above. This is the base building period. It's the exact same thing I showed you on the futures chart right there. This is the same period of time. So back in November, Bitcoin bottomed out, oversold. It began its base building period. Toward the end of its base building period, it kind of crept above into overbought territory. and then the move commences and it moves all the way up to the top of over what would be considered overbought. And the exact same thing is happening here. It happened right here. Again, we're nearing the end of this base building period. We move a little bit above, and then we break up and above, and we really get the momentum on our side. And now, again, like a spring coiling, right? We're gathering all this momentum before we really spring higher. This is the end of the latest base building period, the third one that we've experienced in about 9 months. And as you can see, we're creeping up from down here into overbought territory. And now we've got all this momentum on our side in order to go much higher. Of course, ceteris paribus, anything could happen. The world could explode tomorrow. But this is just another view of the Launchpad that I see being built underneath Bitcoin. Being built underneath Bitcoin. How's that for alliteration? All right, I'll stop it. So switching up the board here to macro, let's talk about macro. So the month of June has gotten off to a really, really rocky start with economic data. First, we're going to talk about the Atlanta Fed. So the GDP Now forecast for Q2, which is kind of analyst estimates. Well, the GDP Now tool from the Atlanta Fed is not a bunch of analyst estimates. It's a tool from the Atlanta Fed themselves. The forecast for real GDP is getting completely slaughtered. Okay, now this is real GDP, so it's not nominal GDP, but it's been revised down repeatedly from 4.1% in Q2 just 2 weeks ago to 1.8% as of yesterday. Okay, that's a massive downward revision. And note that this is a real GDP forecast. Again, so nominal GDP is much higher. There isn't necessarily any room for the Fed to cut rates yet because nominal GDP could be at 5% given where price inflation is now. But what I am pointing out is there's a rapid shift going on, okay? Not just in forecasting over the next several months for the economic cycle, but also in the totality of the data. Where there was strength, the tone is now rapidly shifting to a cooling in the economic activity. Not just any cooling, a very rapid cooling in economic activity. It's kind of setting off some alarm bells here. So that's the first thing I wanted to show you, the Atlanta Fed. And then the second thing I want to show you is actually, I'll pull up my Bloomberg terminal once again. I lied to you. I have a couple more charts. You could see all these tabs I have up here. Is new business orders. So yesterday, the ISM manufacturing PMI, a favorite signal that we have over here at the Bitcoin layer, it is a leading indicator, flashed that manufacturing upstream, obviously very upstream in the U.S. economy, that's why it's such a good leading indicator, is as cool as a cucumber. It's cooling down. And that's indicating a slowdown, obviously, right? If there's a slowdown in manufacturing activity, that trickles down into the real economy that's buying manufacturing inputs. Okay, it only makes sense. So the actual numbers here, headline came in at 48.7, down from 49.2, missing expectations. Prices came in at 57, down from 59.2. Okay, so they cooled as well. Employment ticked up marginally to 51.1. But new orders completely plummeted. So I'll zoom in here so you can get a better look at it. New orders completely plummeted. They went from 49.1 all the way down to 45.4. Abysmal. Abysmal. Okay, that's terrible. That is an almost 4-point drop. That's very bad. New orders, which of course are in pink, having a huge miss below the 50 contraction level has historically marked a cycle shift toward recession. Look how closely this lines up here. Look at all the other instances where new orders have plummeted. Look at new orders plummet, right? We're kind of rocking above this 50 level here, right? We're doing all right above this 50 level here. And then all of a sudden we plummet below, like massive, massive. And then we enter recession. Here, you're chopping around. You see plummet, you see these spikes down, but they're still above the 50 level. And then as soon as you spike below the 50 level, like have one of these huge spikes below or down under the 50 level, you get recession. We didn't get recession here. And then again, when we spiked down below the 50 level, we got recession. So this was kind of a slow move down below 50. We went up into expansion. But you guys got to remember, this is a cycle unlike any other. And so we let off this huge monetary and fiscal bazooka. Of course, there are going to be much longer lags in the slowdown and the cycle shift than there were in previous cycles. It doesn't take a PhD economist to realize that, okay? And so that's kind of why we had this rebound here. And now this, given the magnitude of the move, it seems like the real one. And if it is the real one, then, 3 times out of 4, you know what's happening next, okay? And Nick also did a great video yesterday on that. I would suggest you guys go, or not yesterday, excuse me, on Sunday. So I would suggest, no, I'm a moron. Not Sunday, excuse me, Monday. So I would advise you guys go check that out as well. So the tide has shifted from the totality of data being hot or warm to kind of neutral, if not rapidly cooling in the cases of new orders and all these consumption-related data sets, okay? So new orders, consumption-related data set, construction spending, which is another consumption data set, also cooled month over month, and we got that data yesterday. And not to mention, another consumption-related data set is that consumers have totally run out of cash. And I don't have that chart for you, but what I do have is credit card delinquencies. So you guys know, I've talked about this in previous videos. If you follow me on Twitter, you know this, is that post-COVID stimulus money was stockpiled all the way up to $2.1 trillion in August 2021. Now it's completely drained to negative 72 billion. So people have completely exhausted all the money that they saved up, all the extra money they saved up, and they're dipping into their savings in order to keep up with their same level of spending. And they're also taking on more credit cards. So look at the rate at which delinquencies are going vertical. So this is delinquent balances in mortgage, in orange, in auto, in green, and in credit card. Okay, so people are taking on mortgage payments are late, they're overdue. Auto payments are late, okay, they're overdue. Credit card payments are late, they're overdue. Now, granted, credit card payments, the biggest revolving payment of all, is not spiking nearly as badly as it was pre-2008. Historically speaking, these delinquencies are still very low, but it is telling you exactly what I've told you. There is a secular, not a cyclical, right? So this big, large slowdown in spending and consumption-related things. And it's not just consumers, but it's also manufacturers, as we've seen. It's construction, okay? So everyone is slowing down their spending. And what does that eventually lead to when we measure GDP, when we measure economic growth by GDP? Where spending is a massive component of that measure, you get an economic slowdown. There are no two ways about it. So I have a couple more charts here. Well, actually, this one's pretty big. So again, one last Bloomberg chart. I keep lying to you guys. This is JOLTS job openings. We got another cool thing of data. So this came in 290,000 jobs below expectations. So we lost 300,000 jobs last month. That is the biggest loss in a while, and now we're at the lowest amount of job openings in the United States since February 2021 at roughly 8 million. So that's pretty bad, as you can see here. Very, very big, 291,000 below analyst expectations. And also, look at how many downward revisions we've had. And so this has ended up being much worse than advertised, because this means, when you see red here, that means the initial headline is saying we lost fewer jobs than we actually did. And then it comes out later and they go, oh, well, actually we lost, 100,000 more. Whoops. And they do that in order to kind of soften the blow of bad headlines and project strength as much as they can. And it's all one big farce, right? But the big headline here is that yet another piece of cooling data. We had all this consumption-related cooling data, this construction spending, consumer spending that we already know of. And now this U.S. job openings, right, slowing down. And so next up to bat, okay, what we're seeing here is just the secular trend, but we need to see an acceleration in job cuts, okay? And that is what we're seeing. If you look at the macro edge job cuts tracker, this is a secular shift in the cycle, and it's not just a small cyclical hiccup. Job openings are accelerating. Look at all of these bars. Look at how they've gone up, okay? So the amount of monthly job cuts is trending up, right? So the rate at which job cuts are happening is rising. Job cuts are accelerating. Mega cap companies like Microsoft announced 15,000 layoffs yesterday. And economy-wide job cuts, according to Macro Edge, are already elevated to start the month off of June, which is, again, in line with the cooling data that I just talked to you about. And we had 4,000 job cuts so far in June. Again, note the rising upward trend in monthly total job cuts over the last 9 months. So I'll leave you with this. A phrase here that we've used at TBL quite often is all eyes on CPI. And we'll 100% be doing that next week, because we'll be receiving May's CPI data on the same morning as the June FOMC meeting. We're right now in the midst of an extended on-hold period as CPI notches lower. Very slowly, back to the Fed where the Fed wants it. And because it's coming down so slowly, the Fed is much more focused on employment than CPI at its current rate, because it won't reach target for some time. So it does not like hearing and seeing when things like this happen. It does not like hearing about and seeing job cuts accelerate. And that is where that is the kind of data that we're unequivocally seeing right now in the tape. Okay, so with consumption slowing and leading economic indicators confirming the same, a secular shift toward decelerating activity and eventually economic contraction looks to be afoot. So the last thing here, I've had this tweet pinned for ages. Okay, I've had this particular tweet pinned for, since August. Okay, and people have been clowning on me for keeping it up as long as I have, right? But I do it for a reason. Cycles don't lie, and now I'm being vindicated here. They're different. Okay, this cycle has been extended, but cycle theory is not broken. We're in the longer phase of higher for longer. And the longer phase of higher for longer always ends in misery. The Fed's job isn't to get it right, and they never get it right. And so speaking of this chart, here is an update to this chart. Okay, so we spiked all the way up here. Okay, and this is headlines that have the word soft landing in them, which is in white, then the Fed funds rate in orange. And you'll note that soft landing headlines are nowhere to be seen, right? When the Fed pauses, when it reaches its peak terminal rate, headlines about a soft landing spike and they peak, right? But then they completely go the way of the dodo, and the Fed ends up slashing rates. And what does the Fed end up slashing rates in response to? They don't do it preemptively. They're not good at their jobs. They do it responsively, and they do it responsively to a slowdown. So look at what happened to this dynamic in 2000 and 2008. This looks like vindication for all of my reply guys underneath that pinned tweet. It looks like it's nice. Sweet, sweet vindication. In the meantime, though, let's just enjoy these new all-time highs for Bitcoin. So, again, thanks so much for watching. Very long video today, but I appreciate you guys bearing with me. Let me know how you like this longer format. And, of course, once again, big thanks to the guys over at River, our Bitcoin exchange of choice. You can invest in Bitcoin with confidence when you visit river.com. You can get 0 fees when you set up recurring orders and have peace of mind thanks to their 100% full reserve custody in their multi-sig cold storage solution for all your Bitcoin. They're also licensed and regulated all around the United States, and they have full US-based phone support. And if you want to text Bitcoin to a friend, you can do it. Very, very simple orange pill tool, River link. They're my Bitcoin exchange of choice. They're the Bitcoin exchange of choice for TBL. Use river.com/TBL and get up to $100 when you sign up and buy Bitcoin. Level up your Bitcoin buying game using River. So that's all for today. Once again, I really appreciate it. Make sure you guys like and subscribe. If you're watching this on Twitter, a retweet would be hugely appreciated. Thank you very much. That's all for today's video. Thank you so much for watching, and we'll talk to you guys soon. Thanks.